Hi, this is Linda Hitt. This particular video clip will be about long-term, often expensive, tangible operational assets. Things like land, buildings that we use to run the business, equipment, machinery, furniture, cars, you name it. There's a lot of things included in this category. And we'll distinguish it from things that will be expensed right away or set up more as a prepaid item like prepaid insurance and then expensed. So what makes the list? What is actually added to the asset account? And we call this capitalizing or capitalization of expenditures. It may sound like stockholders' equity, but it's not. This is actually what is included in your building or your equipment account. Again, these are things that we actually use to run the business. No one's surprised that the billing price would be included. It's adjusted for any type of special breaks, such as pay fast, 210 net 30. Maybe you order a lot, may get a break for that. Historical cost is not what you could have paid, it's what you actually paid. And then things that we can't avoid that a good business person would wind up having to pay, a prudent person. Shipping charges, if it's FOB shipping point from our vendor, as soon as it's shipped, we own the goods. And so we often pay the shipping and we insure it and so forth. Installation costs. Sometimes you do have to hire someone to put it in place, get it in working condition, even to get your employees started with it. So a little bit of training could be included. And then sometime during the life cycle of the asset, you may do major revisions. And in the case where professional judgment deems that these major revisions really changes the way the asset's used or changes what it produces in some significant way, such as if Piedmont took a large classroom and broke it and added walls and now has several smaller classrooms, so this helps us to achieve our goals and mission, that would be considered a major overhaul. And then also the possibility that in some assets you might be able to replace the engine in the car, do something major that would extend the useful life. Both of these affect the asset account. In one case, quality of usage adds to the asset. In the case of extending the useful life, you're going to actually reduce the contra asset accumulated depreciation. That balance goes down, book value goes up. If you add to the equipment or furniture account, book value goes up. So both of these would impact book value. So what doesn't make the list? Painting the building, doing weather stripping around the doors, basic things to keep things in good working condition is simply expensed as part of just routine stuff. Certainly when you purchase a car, think about all the things that you wind up paying to have the car and be able to use it. In a separate video clip, we will deal with depreciation, which is just basically using up the historical cost, using up the asset over its useful life. And any special overhauls that we do that don't quite reach the definition of quality of usage and extending the useful life. So as we make expenditures, we have to decide, where does it go, asset or expense? So let's look at our example. And most of our example will deal with simply purchasing and what makes the list. So if we go down the list of things that we've spent, what is actually added to the assets? We're buying machinery. This is manufacturing machinery. We paid, oops, I didn't want to say cash. We're actually charging this. Well, actually, I guess it doesn't matter. Let's just go ahead and pay cash. Usually we see terms, we usually say, don't record cash, it's accounts payable, but you could pay right away. So let's just do that and we won't have to worry about accounts payable. So invoice price before any adjustments is certainly considered part of the cost of the asset. The terms given, if we take 100% minus 2%, if you remember 210 net 30 means 2% off if you pay within 10 days. If not, between day 11 and day 30, you must pay the full amount. So since we're paying right away, I think we definitely qualify. So 100% minus 2% is going to give me 98%. What am I doing? Let me go back over here. So 0.98. Okay, so 8,820 is a good thing. We get some break from it. We're also paying sales tax. I think all of us would agree if you're in a state that requires sales tax, we need to pay that and add it to the asset. We can't avoid that. And then the shipping charges, just because of the terms, I own the goods and shipment if it's FOB shipping point, so we'll add that. So 10,120 sounds like our asset value. So let's type in 10,120, and none of the items were expensed or prepaid. So we'll just do machinery and cash. And just keep it simple and keep everything cash. Just like we said up here, assume cash is paid unless terms are given. Well, even with terms. So if you look at this should be familiar. One asset goes up, the other asset goes down. So we actually have an asset exchange. And there's no effect on profits. We get to cash flow. We're going to look at an outflow of cash. And machinery would be an investment. So buying all these different items to use would be investment. And then I'll go ahead and put it over here. I'll post it to my ledger. So everything is included because we basically wouldn't be able to avoid as a normal person, normal business person. Next, we're going to hire somebody to help us get this machine up and running and even help the employees start to use it. So I think, again, we need this. We can't use the machinery properly without this. So it adds to the list, just like the first entry. And we won't worry about tracking cash. I know you all are good at posting to the ledger here. So once again, it's capitalized and it's an asset exchange. Once again, it adds to, it's a cash outflow for the cash flow statement, and it does add to machinery, so it's investing. And it's added over here. So it's not that we're never going to expense these items like the installation, but we'll expense it as we depreciate the asset later. Now here's one where the employee missed the training and doesn't do something properly and unfortunately breaks the machine. This we could have avoided. So therefore we're going to do some type of expense or loss, and I'm just going to put it in maintenance/repair expense. It's not a major expenditure, but we definitely don't want to add it to historical costs because it was not something, we could have avoided it, and we unfortunately didn't. So this time we expense it right away, so we have less resources. Expenses, of course, are retained earnings items, so in closing it's going to reduce stockholders' equity. It affects the profits. Profits come down, and it's an outflow. And usually any type of cash paid for expense is operating. Okay, so you can see it's a very different effect. We take it right off the books, and over here I'm going to add maintenance/repair expense. Just put it all into one account. Okay. Next, we are paying for an insurance policy. We have to add a little bit extra to cover this machine. Apparently we've prepaid the insurance policy for a year, so if you remember, if it benefits more than a month, you may very well then elect another type of asset account, a prepaid. So we're going to do prepaid insurance, and later we'll have to adjust the books. But in this video clip, we're not going to do that part. We're just going to focus in on the entries. So this is again an asset exchange. Whoops. And once the insurance expires, it'll impact the income statement, but right now it doesn't. So we're going to have an outflow, and eventually it becomes an expense, and we would treat prepaids, usually supplies and so forth, cash paid, as operating. Okay, so I'm going to set up prepaid insurance. Put that up here. And we're going to put that amount there. Again, we're not going to do all the entries, the adjustments, and so forth for this clip. Another thing we do here is that we do some basic maintenance on our machinery. Cleaned and oiled it. Again, this is not changing the quality of usage. It keeps the useful life going. If we don't do it, then we may not last as long, but for our purposes, it's not a significant change, just keeping it in good working condition. So we simply expense it in some type of account. Okay, and so as we expense it right away, we have less resources, stockholders' equity because your retained earnings goes down because of the expense, less profit, and everything's kind of adjusted right away. And again, any expense is operating. So I'm going to add that to our maintenance and repairs for $400. Okay, and then assuming we do all the right things, we adjust the books and we do our statements, which we're not doing it in this clip, but years later we have several things happen. We do a major overhaul in the machinery so that now what we produce is a much better quality product. So it fits with the definition of changes of quality of usage. When that happens, we actually add it to the machinery. And I didn't even tell us how much we spent. Okay, let's say that we spend, I guess it doesn't really matter, $2,000. So we would debit the machinery. We're assuming, again, everything's cash, just to keep it straightforward. And you can see that's an asset exchange. So one asset up, one asset down. It is going between short-term and long-term assets. When we depreciate, we'll expense and we'll have a difference to profit. Right now, we don't. So we just see a cash outflow, and again, it's investing. And this one would add to machinery, which I guess we've got up here. Yeah, we've had those expenditures, so I'll put the $2,000 under there. And again, it would impact depreciation. We'll see that in a separate clip. The other possibility is that we may have done something that extends the useful life beyond the original life expectancy. If we do this, this looks really different, and I'm going to change this amount. Let's make this $3,000. Everything comes out to be $2,000, it seems. So how could you, the first one, number 6, we increase the book value because we increased the asset. Here we're going to still increase the book value, but we're going to do it with an approach of actually reducing the contra asset, accumulated machinery, and credited cash. So that looks a little strange. So what does that really do? Well, if you reduce a contra asset, you actually increase assets. So the debit will actually increase assets. And if you credit cash, of course cash is an asset, so you're reducing assets. So whether it looks like it or not, it actually is an asset exchange. Nothing much happens over here. When we get to the cash flow, it's an outflow of cash, and it does impact machinery. Machinery is investing. So I'll put that there. Usually you would have depreciated a bunch, and you'd have a bunch of credits to accumulated. So I'm going to pretend that we have some numbers there. And so this entry, the special unusual entry, would actually bring down the accumulated depreciation. So you may ask yourself, why do they do that instead of just simply debiting machinery? What it basically does is makes the machinery look younger. Sort of like a plastic surgery, facelift here. It has less accumulated depreciation, has a smaller percentage depreciated, but in the end, both entries, 6 and 7, both affect the book value. They both cause the book value to go up, and they both require a revision in depreciation, which again we'll see in a different clip. Number 8, replaced worn out parts. Once again, this doesn't make the list. It's just simply keeping the machinery going in hopefully good working condition. So that's going to be considered expensed right away. So you have less resources, less stockholders' equity, less net income, and less cash right across the board. And as usual, this is operating. So I think hopefully you can distinguish that maintenance and repairs is pretty much everything except some major significant overhaul. Okay, so we'll leave, I guess, the machinery behind, and we'll take a look at a couple special situations. One of them deals with what if you buy several assets at the same time and you pay one price for the whole thing? How do you separate out? Because we may have different useful lives for different related assets. or different. We may want to use different depreciation methods. So sometimes we kind of, clump things together and call it office equipment, but other times we don't. So in number 9, let's assume that we do want to have separate accounts for the desks, the chairs, the file cabinets, and the bookshelves. And so how do we actually go about this? Because if you add up, we bought all these things, the retail price was different than, we have a special sales price for these. Even this is the selling price, but still, when we finally settled, they were so willing to get rid of their assets that they gave us another discount. So we only paid $2,500. So we want to adjust every single asset that we purchase. So we call this a relative fair value, or sometimes it's called relative sales value method, but we also see it as relative fair market value. And actually, it's a fairly straightforward concept. It sounds very official, but it's really not that hard. So first thing I want to do is add up everything at whatever the price is quoted separately, whatever we know. So the desk is $1,200. The chairs that we want to get is $600 before our special discount, $300, and this is kind of like a going out of business sale that we benefited. So if you add everything up, we would have paid $3,000, but they gave us a price of $2,500. So like maybe a quantity discount here. So what we can do is we can go through the list, and maybe we'll just do this first. You can take each item, so the desk that we're getting, or desk, whichever it is, 1,200 divided by, yeah, that's right, by the 3,000. 3,000 is the total of all the individual sales prices. So I'm going to do it this way, I think. The desk is 40% of the total, and sometimes obviously it's not going to come out nicely and evenly. And then we can do each one of the assets. So we have the chairs next, divided by 3,000. Again, the total price of everything if we paid the normal price. And so the chairs are 20% of the total. And we have the file cabinets. I think you can kind of see where I'm going. Each one is compared to the total retail price of everything added up. So we paid the regular price, or the sale price in this case, before our special quantity discount. We're looking at what proportion each item is to the total of the price of the 3,000 price. And we just have, I think, one left. So the bookshelves divided by the 3,000 is 30%, which I guess we could have figured out without doing that. Okay, so hopefully we add up to 100%. 60, 70, 100%. Okay, so now we actually paid $2,500. So if I take 2,500 times 0.4, okay, that's going to be our desk. So I'm going to put that down here just so we have it. So the desk price was $1,000. I'll just do them in order. And then we can do 2,500 was paid times 20%, which is the chairs. Okay, that was 500. And then the file cabinets were only 10%, so 2,500 times 0.10. What we paid, 10% will go for the file cabinets. And then last but not least, we have the bookshelves. So that is 2,500 times 0.3. 750. Okay, and of course we can probably double check our work if we'd like. Not a bad idea. That's my math was not so good. So 1,000. I'm just adding up the items we just calculated. 2,500. Okay. So now we have, hopefully, we can make each one of these in a separate account if we choose. Now we don't have to, but we have 1,000 for the desk. We have chairs for 500. We have file cabinets for 250, and then we have the bookshelves. So we can do a compound entry and actually debit each one separately, and this, puts it where it needs to be so that historical cost is used, and we did in fact pay $2,500. This is a logical way to break out the costs. Over here, the impact is not so bad. We're simply adding to our long-term assets, taking away from our short-term. So we have a bunch of assets going up and an asset coming down, but it all balances, or hopefully it should. So the impact is pretty minimal except for cash flow. We see cash going out. These are things used in the business, not prepaid, so we're going to put down investing. And I did not have a separate account for all these, but you would have a separate ledger account posted for each of these. If for some reason you didn't care about breaking them out, then you could have just the one account I have over here. But by going through this process, we can now set up separate accounts. We can depreciate them in different methods. We can have different useful lives and so forth. Okay, so that's one example of that fair value method where we paid less than what they were originally worth. In the second case, we buy buildings, and we really have to separate the land that's under the building or around the building that we own from the building itself, because buildings depreciate but land does not. So if we don't have that information readily available, then we have to figure it out. So we have a tax assessment, but if you add up the tax assessment, $600,000 plus $200,000 gives me $800,000. So I can't really just debit the building for $6. So once again, we're going to do an allocation. We're going to split up the costs. So the building is $600,000. If we add that to the land, whoops, I dropped a zero here, didn't I? The land is $200,000. Okay, so we have $800,000. So we can say then that the building is $600,000 of the total of $800,000. So from the tax assessment, what percentage of the tax assessment represents the building? And I'll put over here, the building is 75%. Okay, and then there's no surprise, hopefully, but I would encourage you to double check your math. The land assessment is $200,000. If we divide it by the total assessment, then hopefully it does come out to be 25%. If it wasn't, then I would know I made a mistake. So the land is 25%. So once again, that's your approach. Now, whatever you spend can then be put in. We spent $1 million times 75% for the land. So the land's going to be $750,000. The building's going to be $750,000. And then you do the same thing for the land. Move that over a little bit. The land will be 25%. I know some of you can do the math. I'm just going to go ahead and show it anyway. So what you paid for it times 25% represents the land. So once again, we have a compound entry, and here we really do want to break them out. We don't have a choice with this, as we did with the purchase that we made, the going out of business sale. There we could have lumped them together if we chose to. Okay, so there's the combined purchase, and whoops, $1 million. That's a lot, a lot of money there. Once again, no surprise. It's not a big impact. It's assets increasing, assets decreasing. No expense yet, and for cash flow purposes, cash is going out, and it's going to be investing. So this particular subject, we have a lot of cash flow investing. And then the final things we'll take a look at, and I guess I don't need to, we can just leave that. We are purchasing, excuse me, another piece of land, and we're getting it ready for its first time use. So if you purchase land and pay cash, that should be pretty straightforward. For $500,000. Okay, and the same issues would apply with the land or building. All the sales tax, all the special things. And this one too, if you have back taxes on it that you have to pay in order to get it, somebody didn't pay their taxes, property taxes, that is actually a special case where you do add it to the land. So this is an asset exchange, and for cash flow, it's no surprise, it's investing. Okay. And we're assuming this is land we're going to use again for our operational thing. So you buy the land. We'll put the land over here. We'll track at this one. We cleared the land of unwanted structures, such as an old house. We tore down the house, but we also were able to salvage a little bit. So we were able to sell some of the old things from that house. When you clear a structure you never wanted to use, you never have used, that is considered part of the cost of getting the land ready for its first time use. So land is actually going to be increased, and it's increased for the cost of tearing it down. Let me pop this up. So we add the $6,000 to the land, but if we are lucky enough to get anything back on it, we're actually going to subtract the cost of tearing down the land. So when everything's said and done, the land only cost us $5,000 tearing down the structure, added to the cost of the land. So we're going to add $5,000 to the land and then take away cash. Now, if you bought the land, there was a building on it, you used the building to run your business, and then you tore it down, then this is not the case. See, we just expense that. But here, you're getting your landscaping it, you're digging the hole for the structure, and you have to get this off. It was never intended, you didn't want the structure. So that would be added to the land as part of the cost of getting it ready. So this is a cash outflow, and it's part of land, so it's investing. And so the land account would go up for that. It would not be expense. Okay, so I think we've looked at some special issues. We've also looked at the basics of simply buying it. So in the next video clips, we'll be looking at depreciation and the disposal, rather.